the rate cap would have been too expensive for the size properties. These were smaller assets by syndication standards, and we were better off having extra liquidity on the side to pay extra debt service potentially than paying for a rate cap. We recognize that we need to put perm debt on these properties as soon as possible, even if we aren't finished with the business plan. We could do it out of cash later on, and that's what we ended up doing.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
All right, welcome everyone again to another episode of Spur Equity's Spur Your Wealth podcast. We are your hosts today, Param Singh and Rav Singh from Spur Equity. So as you guys know, on our podcast, we aim to bring successful investors, experts, and thought leaders to the podcast to share their story and secrets in investing so we can all stand to benefit from that experience. So on today's episode, we have entrepreneur and investor Michael Voulgarakis. He's a seasoned industry expert with over 17 years of commercial real estate experience in underwriting and asset management. Michael oversees operations, capital raising, asset management, and investor relations at Southgate Ventures, while also playing a crucial role in deal sourcing and underwriting. So with a focus on the Puget Sound region of Washington State, Southgate has successfully acquired and managed 20 properties, completing 14 full cycle deals in just 8 years. So in the course of that professional journey, Michael has successfully underwritten $1.62 billion in commercial real estate loans and asset managed $300 million of real estate assets. So tremendous experience that Michael has. So we are really looking forward to the conversation today. Welcome, Michael. So happy to have you on our podcast. Really looking forward to the conversation that we're going to have today.
Thank you very much for having me. I appreciate it.
So, Michael, I know, just to give you, that was an intro of what you're doing today, but I know that your journey has started a long time ago. So why don't you spend a few minutes just kind of talking to us about, where that journey started and how you got to where you are today at Southgate?
Sure. I was really born kind of into a family that was involved in real estate. My father built single family homes. As a kid, I was the, free labor. As a preteen and a teenager, going on job sites, doing whatever work needed to be done for various tradesmen. So I sort of cut my teeth there with understanding how properties are built. After college, I went off and I had went in a different direction. Started working for some companies in sales. But while I was working for those companies, the bug started to bite me. And I started, from the knowledge I had of public records and real estate, I started buying condominiums in the town I was living in and buying them from absentee owners, renovating them, and selling them or renting some out and selling them later. This was, before the Great Recession. Sold everything right before the Great Recession. And I wanted to buy an apartment building. I had never purchased anything that was income producing. And there wasn't all the information that's out there today, not nearly as much, right? There was a lot of textbooks, which are very, they're very thick, they're very dense, and they don't boil the stuff down for you necessarily. So I said, I'm going to get a job in the industry and I'm going to go get an education. So I went back for a master's degree in commercial real estate finance at New York University. I took a job as a commercial appraiser in Manhattan. Shortly, I think I was in that job for about a year. I ended up getting a job at Morgan Stanley on their commercial mortgage-backed securities desk, underwriting CMBS loans. And the Great Recession happened. I had a front row seat to watching the implosion, I think, a little bit before your average person, because
Yeah.
our market just came to a halt,
Yeah.
and it ground to a halt. That was the end of that cycle. Um, but I ended up doing a lot of consulting work and working for through a number of companies. And I ended up getting a job at a mortgage REIT, which does my primary job was as an underwriter for bridge loans. And I think we increased our business by double each of the 4 years I was there. We were
Hmm.
basically underwriting deals and providing capital to sponsors who were finding these busted up multifamily properties all around the country that had been, the keys had either been handed back to a lender,
Hmm.
or a sponsor had run out of money mid Great Recession, couldn't complete the business plan. And they were all value add investors coming in. And that's where I learned that business play, if you will. I had a front row seat, maybe a second row seat, right? Because I'm not the sponsor per se, but I could see their business plan, what was going on in various markets. And my partner and I worked there together. And when we had a few dollars in our pockets, we started investing. A couple of New York City, guys behind a desk. People thought we were crazy, but we decided to pick Seattle, Washington, as the market we were going to invest in.
Hmm.
And my partner ended up moving to Seattle after we bought a few properties and proved out our thesis, which is that the West Coast markets, your San Francisco, LA, Silicon Valley, San Diego, were far more expensive on a per pound basis than Seattle was. Not that we ever think Seattle will get to those price levels, but we said there's so much arbitrage there, so much room for rents to grow
Yeah.
and housing prices to grow. And there's a very large pool of older assets in that market, built in the 60s, 70s, and 80s that, mom and pops own. And those assets are going to be turning over.
Turning. Right.
And we've grown the business, organically over the past, over about 5 years. And I was doing this part time. And then about 3 years ago, I ended up jumping off to do this full time to try to grow the portfolio.
Wow.
That's
Uh,
great.
yeah, amazing, amazing journey. I really appreciate you letting us know, where you've been, right, based on where you are today. And for you, I'm assuming this is going to be deja vu in terms of what you were doing in New York versus where the market has been in 2023 and what we are doing right now. I mean, there's a lot of sponsors, there's a lot of folks that are having a hard time holding on to some of the properties, and just based on where the financial markets are, where the capital markets are. And so you've kind of gone through that, maybe not as a sponsor itself, maybe not as an owner, but having that second seat that you were just kind of talking about. So give us some insight on that. I mean, when you were underwriting those deals and when you were looking at some of those projects to fund versus where you've seen the market in the last 24 months, or at least specifically last 12 months, what are some of the correlations that you've seen in the market that you had seen before versus what you've seen right now? I mean, is there opportunity right now? Do you think there's opportunity for your company to say to take some of these projects, or move forward? Kind of let us and our investors know regarding that.
Sure. I think at any point at the end of a cycle, whatever that might look like, and you can identify a cycle, sometimes by the capital markets, right? The
Mm-hmm.
capital markets are a huge driver of activity in purchasing and selling properties. So my partner and I didn't panic when we saw the Fed starting to raise rates.
Right.
We said, "Oh, here it is. They're ending the current cycle,
Right.
Hmm.
and this is going to be. It's not going to feel good, right? We think activity is going to slow down, but it was one of those situations where it's not going to last forever. They're going to raise rates until they feel that they've beaten inflation.
Mm-hmm.
um, Now, the data kept getting worse and worse, right? The Fed puts out a report. It's called a dot plot chart, which I would encourage everybody to download off their website. And all it is the Fed's projection of where all the Fed governors' votes come out on an average for where the Fed interest rate is going to be. And you can clearly see, as time went on, that the projections kept going steeper and steeper and steeper. And we said, this is going to last. This is going to last a year and a half, a year. And yes, they're going to raise them very, very quickly. So it comes down to it's a classic real estate issue. You need to have liquidity through these times and to support yourself, to support your business if needed. But if you have that liquidity and you can survive through these times, it's just a matter of getting to the other side of the cycle and having some capital and assets remaining so you can take advantage of deals that people didn't have the liquidity to hold on to the deals, or it doesn't make sense for them to put any more liquidity, any more money into a deal because the numbers just aren't going to work anymore. They could be some combination of they overpaid or they over improved it, or because of where debt is today, they're just not going to be able to hold on to it.
Right.
So those are the deals I think will fall out, meaning those will be the opportunities, deals that were bought late in the cycle, ultimately, that people can't hold on to.
Well, the other thing that we've seen, even the last in the recession, as well as we've been talking about now, is that when you come out of that cycle, there's still so much fear, right? That are we through it? Are we through it? And so there's less players in the game, right, to actually take advantage of these opportunities. And we saw, back in 2008, 2009, once we kind of came out of it, the folks that actually took action, right, made out really, really well, right? Because they, whether it's the real estate market, whether it's the, the stock market and other things, right, they all kind of correlated at that time. So like whoever took action at that time actually reaped those benefits, versus there was a lot of people still sitting on the sidelines like, I don't know, right? I'm still scared. Like I got burned. I lost something, in this last cycle. So I'm scared to jump in. And I was one of them. I remember, Rav and I were dealing in single family homes at the time. And we, we started a new business right at that time, and it didn't go over well because, what happened to the market. And so it took us both, especially me, it took us a long time to come back and say, okay, I'm going to start investing in real estate again, versus if I, had taken action immediately after, kind of understanding those cycles. Even when you understand it, there's still a fear component that you have to get over. And so
Yes.
this time around, we're saying the same thing. Like you said, you and your partner were like, okay, here it is. Here's the end of the cycle. Rav has been saying, he's like, it's going to come. Even before it came, he's like, it's going to come. Like these things will happen. I've seen it multiple times. It's just a matter of when. And so when it does, we have to be ready. And so cash is king, like you said, have some liquidity so that when opportunities come, we're actually in a position to take action. And so, that's kind of the guidance that we've been giving other folks as well. Now, let me ask you a question this time around, with things, because a lot of people they weren't protecting themselves necessarily in the right way. Like, again, the variable debt, the cheap variable debt that everybody was counting on, that turned out to be, something that bit them in the ass, right? A little bit, right? Not a little bit. That's the main factor, that those adjustable rates went so far up that you couldn't even fathom that this was where my monthly mortgage payment was going. So talk to me a little bit about your strategy, with the assets that you had, and why you weren't kind of freaking out when the rates were you protected against it? Like, what were your strategies to kind of make sure that you were protected from that risk?
Right. So there's something called a rate cap. You may have talked about it before,
Right.
on your show. We did not have rate caps on our debt. We had two properties that had floating rate debt on them at the beginning of the hiking cycle. And the properties were, the rate cap would have been too expensive for the size properties. These were smaller assets by syndication standards. And we were better off having extra liquidity on the side to pay extra debt service potentially than paying for a rate cap. So we did have to move fast. We recognized, like, we dropped everything that we were doing. We were finished renovating one property. We got that refinanced. Everything went fine. The second property, we kept renovating, but we said we're not going to draw any more money off the bridge line of credit that we had because the rates kept hiking faster and faster. And we recognize that we need to put perm debt on these properties as soon as possible, even if we aren't finished with the business plan. We could do it out of cash later on, and that's what we ended up doing. We got perm debt on these buildings and stabilized them, finished the renovations, and we didn't get burned, if you will.
So you had the foresight. I mean, you saw this come in, where you were able to navigate that, get the permanent debt on these properties. So I'm assuming your properties probably have pretty low interest rates right now, and they're fixed for a while, where you don't have to worry about rate cap. You don't have to worry about any adjustments happening in terms of paying loans to the banks right now.
Correct. Everything's fixed rate. We're very happy with our interest rates. And I think, it goes back to, and I'll admit that these rate hikes came up fast, right? For so long. I mean, if you were listening to the Fed or economists in general, as they're printing money, they're saying there's no inflation, and then you start seeing inflation in your own personal life. Like, what is my grocery bill now? And everything's becoming more expensive. And then all of a sudden, the Fed admits there's inflation and we need to do something about it. But they turned on a dime. It seems, right? And, memory is a funny thing, right? Looking back, it seemed as if that's the case. But I'll go back to the Fed dot plot chart. You have to, they put it out every few months when they have their meetings. It is the leading indicator to figure out what the Fed is going to do. And when you start following that, you see, they are going to start hiking. It's going to be an exponential growth in hikes. So we realize then we have to retire this floating rate debt and lock in some fixed rate debt as soon as possible.
That's amazing. That's great. And so congrats on doing that, for your properties and for your investors, I think, to protect them. You'd mentioned when you were doing renovations in some of these properties, are you hiring a GC, or do you have a team? Tell us a little bit about your process on how do you manage some of these properties.
Sure. We are what's called a vertically integrated company. We do all our own property management, all our own construction management, and all our own maintenance. Seattle's a very competitive market. It's a very, I'll call it a tight market. And it's expensive to buy units there, right? We're buying things for $250,000 a door, give or take, pre-renovation, and trying to create either a $325,000 to $350,000 a door valuation post renovation. And we're putting in a lot of money in each door for both common areas and in-unit renovations. It's typically between $20,000 to $30,000. It's extensive, right? These are very tired assets. So for us, it's made all the difference in the world to have what we call boots on the ground, which is my partner. He lives in Seattle. He oversees the construction management and property management and maintenance. And we have an in-house crew that can be on site. The day after we purchase a property, renovations beginning
get started
that quickly. And I think one last point is speed is everything when you're renovating. Speed is everything if you're constructing, right? If you have floating rate debt, you have to get it done as quickly as possible to get perm debt on to stabilize the asset. Even if you're not achieving the rents you thought you were going to achieve right away, get what we call butts in seats, get tenants in place.
Get people in place, right?
And you can work the rent roll later to get to your market rent, right? But the most important thing is to get off floating rate debt as quickly as possible.
So you said it, speed is everything. we have a saying on our side when we're talking about new construction and renovations, heavy renovations, is time kills the deal.
Yes.
Like everything that you planned that was going to happen, time is going to kill it, because the longer it takes you to do construction. And we saw this through COVID, right? We saw supply chain issues, and we had a new construction that we were doing through COVID that continue to go longer, and we saw those numbers, like our projection numbers, kind of come down. But yeah, time kills the deal. It's the same thing. It's like when you're dealing with time sensitive kind of income projections and things like that, like for new construction, you're not making any money until those units are done and leased. We have no income to show until that is done. And also, the longer you go, the higher your construction costs typically run. So absolutely, time kills a deal. And so we're doing new constructions now. We're still doing new construction, but you learn stuff along the way, and how to mitigate against those kind of time risks and things like that. But that's something folks need to know with new construction or a heavy reno, or like you're looking at properties that are, let's say, 50% occupied and you need to fill the rest, versus something that is, again, stable day one, and you start making money on day one after you purchase. So there's a little bit of a different risk profile, as it were, right, with different types of assets as we look at that.
Michael, how about on the management side? Right. I mean, on the construction side, I understand that. On the management side, since you guys have in-house management, what are some of the things that you guys are doing right now to lift the NOI from a management perspective? Managing a property itself. I mean, of course, looking at expenses, but what does that mean? Just tell us a little bit about what amenities are you providing, or what expenses are you cutting down in order to make sure that you're bare bone, but at the end of the day, you're still being competitive with whoever you're competing with in the market.
Right. So we've done a number of things to improve the product that we provide to our tenants. As I mentioned before, the buildings that we're typically buying are very tired assets. They typically need a complete facelift. So, providing a building that is not new construction, right? I would still consider this Class B, B plus, even after renovation.
Mm-hmm.
But that is, aesthetically pleasing to our tenant base, a place that they want to live, a place that's attractive. But part of that is also a place that is safe and convenient. And what that means is we fence our properties. We put security cameras up. We put new lighting throughout the properties. We want every resident to not be worried about shadows and
Sure.
anything like that. You want to come home at night, and you
Sure.
want to park in a well-lit lot and walk to your unit, which has well-lit walkways, and know that there's cameras around to deter anything bad from happening. We've never had any bad incidences, but it is a city, and it does help to provide that
Sure.
type of amenity.
Safety, sense of safety, right?
Correct. We'll also swap out, all the windows, sliding glass doors as well in units to provide, more energy efficiency as well. And as far as boosting revenue, because the properties we're buying are typically have been from small operators,
Sure.
they're really not doing much to maximize revenue. In part. The biggest expense is they were not building back for rubs. They're not charging people for utilities. One of our buildings had the original electric fired hot water heater from 1960 something. It was the most energy inefficient dinosaur that we've come across. We swapped that out for a new gas fired boiler, and we dropped the electric bill by half. I mean, the utility bill by half.
Right.
It provides better service, and we're able to charge the residents legally for those utility bills as well. Same thing with parking. Parking in the city of Seattle is at a premium. It's a dense city. We are able to charge for parking too. So those are two other big things that we're able to boost NOI based on, aside from increasing the rents from the pre-renovation to post-renovation.
Awesome.
So, Michael, I looked at a little bit of what Southgate does, and the one thing that kind of spoke out to me, and I'm a technologist at heart. So my background is IT consulting, and doing things in a better way, embracing technology. And I know that that's one of your company's kind of values. And so, can you talk to me a little bit about on the management side or on investor relations side? What are some of the things that you're doing to embrace technology to, again, bring that better experience, one, better experience to your investors, and two, just an overall better visibility into the data that drives your operations, right? So you have insight as to where we can do things better or do more with less, right?
Mm-hmm.
Because that's really going to be the challenge going into 2024, and we're looking at the capital stacks are different, debt is not as cheap, so we have to squeeze more out of operations. So how are you looking at a technology to be able to get more efficiency out of operations, to be able to do a bigger ROI, right, from an investor standpoint?
We started using some great property management software about 3.5 years ago. It has made all the difference in the world, in as much as it makes all the difference in the world to us as operators as well as to the tenants, and we've heard that
Mm-hmm.
it's a far more seamless system than I think. However many years ago before this type of software was available.
Yeah.
Let's talk about maintenance requests, for example, right? 20 years ago, if I'm renting an apartment, I have something broken in my unit. I maybe I email somebody, maybe I call somebody, but it goes into what I'll call the black hole, right? You don't know if someone's going to get back to you, and you don't know if someone's going to call you back. So the software that we have allows a tenant to send us a description of what's going on in their unit, a photo, if necessary, of what's going on in their unit. And it doesn't just go to my partner. It also goes directly. It does go to my partner directly, but it also goes to our maintenance crew directly. So there isn't this chain that needs to be, that you have to go through to get to the proper person to fix the issue. And our maintenance crew is able to reply to those individuals via text or email. And the texting is, today, tenants love receiving a text. Like, we sent out a weather warning text to everyone today saying, hey, there's a storm coming, et cetera, et cetera. People are much more likely, we found, to respond to the text and say, yes, you can come into my unit at this time or this time or this time, and let us know whether the issue's been resolved or not. So the communication is vastly improved, and it significantly cuts down the time to resolve issues. So what do you end up with? You end up with happy tenants. They're paying us a good rent, and in exchange, they want a nice place to live with their problems resolved as quickly as possible. So what does that result in? From an income standpoint, I think we have pretty good retention ratio, meaning tenants do tend to sign up for a second-year lease or a third-year lease with us, which says that they're happy with what we're providing them. So that to me is I'll call it proof in the pudding that software helps us out tremendously. It also helps us because I don't live in the Seattle market, right? My partner does. But what I can see on our property management reports is the types of jobs that applicants to our units work in. I can see their income that they make, and I can get a sense of, like, hey, who's looking for an apartment at our buildings, and it just helps in reading the market and learning the market and understanding, oh, well, we have a nuclear engineer who wants to rent our unit and he makes $110,000, or there's a lady who is an Amazon software engineer who makes $95,000. These are great tenants to have, right? Highly
Yeah.
educated, make good money, make 5 times the rent, which is our average in our units. And those types of people in a Class B unit, we have not had any collection issues
Hmm.
with our tenants
Yeah.
all the way through COVID. So we our play is high from a financial standpoint, high quality tenants.
Yeah. And you see that with sort of big data, with technology, with just having reports, and really not just having reports, but understanding and reading those reports, and getting an idea of who your next tenant might be at that point.
Correct.
Great.
Well, that's great. That's great, Michael. So as we kind of wrap up the conversation here, I do, I think we've really, I definitely want to have you on again because we want to talk a little bit more about Seattle. I know that a lot of our listeners would be interested in that submarket and really trying to understand kind of where that market and submarket is going from an investment standpoint. But as we wrap up today, I want to, any final thoughts, because we have listeners that are, again, investing in different geographies, different types of assets with us and with others. We have some investors that are not necessarily, or listeners that are not investors yet, or they're looking to invest, or what that kind of maybe the 2024 is their opportunity to kind of jump into the market. Any final words of wisdom? Any final thoughts? Anything that you want to share with our listeners, Michael?
Yeah, I'll make I'll provide a nugget or two of the high level metrics that whether you're a passive investor or whether you're looking to be the sponsor and syndicate a deal, or you just want to buy a building, with your own funds. Um, some of the fundamentals that you can look at to get a sense of whether a market and a deal have potential and you want to get involved in it, are sort of the basic blocking and tackling of real estate. You want to understand the economy in that market. What are the jobs? Because real estate is a lagging indicator, right?
Yep.
Jobs are the things that make real estate valuable, not the other way around. So what jobs do people have? What is the likelihood of those jobs sticking around, right? Are they in danger of going away? Is it an industry? Is it overexposed to an industry that might not be there in the future, or is it the opposite?
Mm-hmm.
And then understanding the average wage of those jobs. This information can be found for free on the Bureau of Labor Statistics website for all the metro areas in the United States. You can see the average wage. And then as far as the deal is concerned, you want to understand on the pro forma, right, which is essentially your cash flow statement for real estate. There is income on the top and expenses on the bottom, right? For the income piece, you want to look at, okay, what is the average in place rent per square foot today? And is that, quote, market, end quote, right? Is it below market? Is it above market? Is it about market? If it's below, and you have to do your research to, call around and look at comps and understand, well, hey, if I have a building here with, $25 square foot rents annually, and but actually the building next door to it or right down the street, which is similar vintage, is getting $32 a square foot. Well, that's an opportunity there to grow the top line revenue. On the expense side, without getting into detail of each line item, just go with a high level, what's called expense ratio. Talk to some experts in the market, an appraiser, brokers, etc., and say, hey, for this vintage and type of building, what's the average expense ratio, right? The answers might vary a little bit, but the more people you ask, you will see that median or mean answer, and you'll say, hey, this market's a 35% expense ratio. And if you have your income and your expenses, and then you figure out your cost of debt, that's how you can start to size deals back of napkin, as they say, to figure out whether it's worth diving into anymore.
That's great. I love that. Thank you for sharing that. That was a quick underwriting kind of tips from Michael. That's excellent. So, Michael, I want to thank you for your time today. Thank you for sharing your story. Again, I want to have you back on just so we can dive into a little deeper into that Northwest market. I know that we have a lot of folks that are interested in that market, and so we'll dive into a little bit more details about what you've been doing there in terms of properties and what you've seen in the years that you've been in that market. So really want to again thank you for your time today, and really enjoyed the conversation.
Absolutely. Param and Rav, I really appreciate you having me. And I would love to continue this conversation about all things real estate and the Pacific Northwest as well.
Michael,
Excellent.
if our investors want to reach out to you, just if they have any questions for you, how do they get to know you?
Sure. They can visit our website. It is the name of the company is Southgate Real Estate Ventures. The website is sreventures.com. So SREVENTURES.com.
Excellent. Great. Well, for our listeners, thank you for tuning in to this episode of the Spur Your Wealth podcast. Again, we are your hosts, Budham Singh and Rav Singh from Spur Equity. Remember, your journey to financial freedom, it begins with both knowledge and action, where knowledge is power,
but action is superpower. So until next time, happy investing. Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at spurequity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@spurequity.com. Until next time, happy investing.